Google reported its earnings yesterday and was down almost 8%. It has recovered slightly, down 6% today. So is it a strong undervalued buy now after the drop almost $10 to the share price? As always, we're going to take a look at the historical performance of the company. We'll look at their top line revenue growth, their bottom line net income, understand where this pessimism is coming from. We'll look at the balance sheet, a quick health check, total cash versus total debt. And we'll also see how well they performed against their competitors and an industry as a whole over the last 5 years. We'll analyze some of their financial metrics, their free cash flow, and some other important net debt to EBITDA metrics. We'll see what the institutions are doing, whether they continue to buy in the latest quarter. We'll also touch very briefly on insider buying and selling. And importantly, we'll take a look at their earnings and see exactly what went wrong for this huge drop. Don't forget, we will also run them through the valuation model, getting to the intrinsic value, as well as that acceptable buy price given the investor margin of safety. And we'll look at Wall Street and see what they are forecasting for the next 12 months. So let's jump straight into their earnings, which is very important. Now, the headline reads that Alphabet misses their expectations on Google ad revenue, sending the stock lower. So let's try and get a feel for the numbers, see exactly what is going on. Now, when we see the revenue, we can see, excluding the Intrinsic acquisition cost for the Q3, 72 billion versus 71 billion estimated. So they did beat that. And on top of that, it was higher by 63 billion in the same period. Now, we can take a look at the numbers, but as you can see, they have beaten quite positively on a lot of it. The revenue, as we just mentioned, 72 versus 71. Look at what that was in Q4 2022. Earnings per share, 164. It beat on that, 159 expected by Wall Street, and it beat from the Q4 2022. Cloud revenue, 9.2 billion versus 8.9 expected. And it beat. So a lot of beats, not only in what Wall Street expected, but also in the Q4 of 2022. Now, why exactly did this company's shares go down so significantly? Well, this is the reason why. Their ad revenue, and you may be thinking such a small miss, 65.5 billion with Wall Street expecting 65.8. So they missed by 300 billion. And they still beat Q4 2022. So this is why Wall Street are worrying. Their ad revenue, which makes up a significant portion of Google's revenue on the top line, did miss by 300 million. And this is the reason why we are seeing these issues with the share price. So let's jump in now and see whether or not this is an undervalued buy. And for those that are interested, we can see their revenue year on year increasing over the long period. So let's take a look over the last year. Yes, they are up 56%. Bear in mind, though, the share price has dropped, so this price will lower. And we can see it is in the upper to midpoint of the 52-week range, as it will go down to around $142. And this PE will drop slightly into the 20s. Over the last 10 years, if you've been holding on to Google, you would be up 414%. And for those that are new to the company, they do not currently pay a dividend. Now, in terms of the top line revenue, what do we always like to see on the channel? At a minimum, 3 to 7% growth year on year. 137 billion reported in 2018, 282 billion in 2022. And we did see, yes, an increase to their top line expected in their full annual report. So it is positive. They are increasing their top line, as we can see here, year on year. But it does look like Wall Street are not liking the fact that their ad revenue has missed, even though it is by 300 million, and hence why we see such a massive fall in the share price. Net income, well, 30.7 billion in 2018, 60 billion in 2022, so they've increased their bottom line by, in fact, double, which is very positive. We can also see continued increase to the bottom line up to 2021 before a drop in 2022, although we do note a 10% expected increase to the bottom line, although it still isn't higher than that 2021. So yes, the bottom line and top line have increased over the last 5 years, just some small inconsistencies on that bottom line. Quick look at the health check of the company, total cash versus total debt. 109 billion reported in 2018, 120 billion in their latest report. So they are holding a lot more cash than they did 5 years ago, but they just hold a significant amount regardless. Now, when we take a look at their total debt numerically and directionally, it has gone from 4 billion, which is a lot in 2018, to 30.5 billion. Again, a very large increase over the period, but something just to bear in mind, they have a significant amount of cash. So when we do look at that net debt to EBITDA metric, it probably won't even take them one day to pay it all off. Now, over the last year, we can compare companies in the interactive media and services industry, Meta, Tencent, Snap, and a few other well-known companies. Now, over the last year, Google is up 56%. This is total return, although the majority of these companies do not pay a dividend. The second best performing, in fact, over the last year. When we extend this to the last 5 years, in fact, Google, as we can see clearly, is the best company out there in terms of its peers. But as we always say, past performance is never really an indicator for future performance, just something to bear in mind as we run through our analysis. Institutional ownership, well, it sits at 35%. In terms of the sales, well, around 51 billion worth of shares sold by the institutions over the last 12 months. In terms of buys, well, 63 billion over the same period. So a lot of sales, but also a lot of buys, in fact, slightly more buying. So the institutions do quite like Google, even at the current price. As we can see in the two latest quarters, Q3 and Q4, more buying than selling by these institutions. But it is important, I do say it all the time, always do your own due diligence, never copy what the institutions do. Now, I've put in the two stock ticker symbols for Google, GOOGL and GOOG, and we can see over the last year there has been no insider buying or insider selling. One thing I would point out, though, they do have a very high share-based compensation package for management, in fact the highest out of all the companies there, something just to consider. Now, let's take a look at their financial metrics and see how strong this company has performed over the longer term. Now, in terms of free cash flow per share, 89 cents in 2014, 274 in 2023. We can see it has increased up to 2021, pretty strong, in fact, more than 5 times, although we know the opposite has started to happen, 274 in 2023. Yes, in 2024 it is expected to increase, but something to keep in mind is whether or not this growth that we're about to run through for Google is starting to slow down slightly, given how strongly they have grown. And that is probably something you may be able to deduce from the sales growth that we see. Pretty much double-digit increases to their top line every year, bar 2023. And we can see it has started to come down. Yes, we know the very strong year in 2021. But is it now that from Google moving forwards, given how strongly it has grown, given all the expectations from Wall Street, are we expecting now to see purely high single-digit growth to their top line? Let me know your thoughts in the comments below. Total sales was 66 billion in 2014, 307 billion in 2023. It is a huge company. It still continues to grow. But if you do look at the graph, it does look like it is starting to slow down in the more recent period. Shares outstanding, not really what you want to see. You want to see companies do share buybacks. What we've noticed, though, with Google, they've done share issuances. They've diluted your position quite significantly from 13.7 billion in 2014 to 25.4 in 2023. In terms of ROIC, regular viewers know that this is one of my favorite metrics. It gives me faith that management are able to effectively allocate their capital if we see numbers above 10%. The last 3 years, very strong in the high 20s, which is positive, which doesn't really make me worry when they don't pay out dividends, given how high the percentage is on that ROIC. So I do like that, and if it continues in the high 20s, that is very positive. Both operating margin and free cash flow margin very positive at a strong, consistent level year on year, and that can be said the same for the free cash flow margin as well in the most recent period. So very nice with their margins, nothing to highlight there in my opinion. And as I mentioned, this net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us the strength of the company's balance sheet, which we did just take a look at. It is very, very strong. It wouldn't take them even one day to pay off all of their debt net of cash on hand. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. It should come as no surprise the first model isn't applicable for Google. Graham's valuation isn't really used when companies have strong double-digit fast-growing growth. So let's jump into the first model. We have multiples valuation model, companies in a similar sector and size. We have their average PE multiplied by the earnings per share of Google to get an intrinsic value of just over $200. We have our first sign of undervaluation. Do keep in mind though, we're not looking at any of these models in isolation, and we will draw conclusions towards the end. The second model isn't applicable. They don't currently pay a dividend. Let me know your thoughts on that. Maybe you do prefer Google to start paying a dividend even though they have a high ROIC figure. We then move on to the DCF model, free cash flow year on year for Google, average growth rate 23%. Now I do continually go a bit more conservative with the outlook, so it is below analyst estimates and the average. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and then we get to that intrinsic value, another sign of undervaluation. Now, in my more recent videos of Google, I have classed it as one of the cheapest, if not the cheapest tech company to buy, and I still do believe that. I will be covering other tech companies, and you will be able to get a sense of whether or not you agree with that as well. In terms of the intrinsic value in today's episode, it's coming to $181. And as always, if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, or even those on your watch list, do click on that pinned comment below. So typically we start off with a margin of safety of 10%, and we use that if we believe it has a wide moat, strong financial metrics, good forward-looking data. A lot of people will argue with Google they're satisfied with 10%. With 15%, it is still a buy, and at 20%, it isn't too far off the current trading price. As always, though, do let me know your thoughts in the comments below whether or not 20% is significant enough for you to add this company. It is towards its 52-week highs, not anymore after the 6 to 7% drop. And in terms of Wall Street, what they're forecasting over the next 12 months, well, they see a price target of $165. They see upside of 16%. Now, the share price when the market opens could go even lower, so we could be looking at a higher margin of safety. For me personally, this is one that I do hold in an ETF. It would really have to be extremely undervalued for me to enter. We're talking at least 35 to 40%, around $120 before I even consider. But as always, it does depend on your own circumstances. People will pay a higher price. Some people may not even buy this company as it's already in their ETF and they're happy with that exposure. As always, though, do let me know your thoughts in the comments below. Smash that like button if you've enjoyed this episode. Also, if you want to join our free weekly newsletter, completely free, click below. This week, I am just drafting out the next newsletter. It is going to be a great one. As always, have a great day. Catch you on the next episode, and take care for now.